Welcome to Real Estate Focus. I'm Kelvin Law. Our topic today is home financing. With me here today is Kathleen Caddell. She is the Senior Loan Officer from Fairway Mortgage Corporation. And she's here today to share her insights with the viewers and consumers about home financing. And Kathleen has 10 years of experience as a loan officer in the business. Welcome.
Thank you. It's a pleasure to be here and an honor, so I thank you for having me.
Great, we're gonna have a great show.
Absolutely.
So having said that, if you can share with the viewers in terms of the procedures of getting a pre-approval letter, what type of documents that the buyer should prepare to provide the lender or to you before they talk to you, or even have you look into whether they would qualify for a mortgage or not. And there are different type of documents, if you will, that the buyers will have to provide you with. So if you could please share with the viewers with the type of documents, and the screen is gonna show the type of documents that are required from them to provide to you.
Absolutely. So the key thing is the number 2. So we need to look at 2 years complete tax returns, 2 months most recent complete all pages bank statements, 2 most recent pay stubs, and 2 years worth of W-2s. And that is the minimum that is required by anybody. So therein lies the major difference between a pre-qualification and a pre-approval. And it is so critical that if you're talking to anybody, you make sure that they are a licensed loan officer. But in addition, if somebody has not looked at your complete 2 years, all schedules, all pages, tax returns, that should be a caution light for you, because that doesn't mean you are in fact truly pre-approved, and you could be caught up in what we refer to as a mortgage gotcha. For example, perhaps you are writing off some unreimbursed business expenses. Well, we have to deduct that from your income, and that can make a big difference on your qualification to make sure you're in the right price range for you, and also to make sure you're in your right budget for yourself. So unless someone's completely reviewed your 2 years worth of tax returns, 2 months bank statements, 2 years W-2s, and 2 most recent pay stubs at a minimum, you are not doing yourself a favor. Often I'll be asked, this is kind of painful to give all these documents up front, and I say yes, and it is, absolutely, I agree. We joke, I don't need blood and urine just yet, or your firstborn child, but we do need your full, complete financial picture. And unless you've gone over that up front, you're not doing yourself a service at all, and you're not truly pre-approved.
And based on the other documents or requirements that they might have to provide, like asset management. So if you could, explain to them as well.
Sure. So if you have any, the bare minimum, we're looking at 2 months complete bank statement. So that would be your checking and your savings, all pages we need at least a 60-day minimum on that. But if we're talking about money under management, or your retirement accounts, such as 401ks, or your IRAs, maybe you have a trust, perhaps you have money invested, we need the most recent quarterly statement and all pages at that. And probably that's one of the big mistakes. People just give me the summary page or a transaction detail, and unless we can see the full complete statement, and it says page 1 of 14, we need all 14 pages. You essentially can't leave a question in the underwriter's mind. And the reason being, and I always like to explain the reasons instead of this is just the rules, is we need to see that you've had the ability to save and essentially where that money has come from. If all of a sudden the most recent statement shows you have $100,000 in the bank, but last month you had $10,000, we need to know where that 90 came from. Every penny needs to be sourced when you're making a purchase.
Mm-hmm. And the last set of requirements that are needed for condos. Mm-hmm. So if people want to purchase a condo, let's say, and there are type of documents that come along with the loan, so like those documents right there.
Correct. If you're purchasing a condo, we provide you with, any lender will provide you with a condo questionnaire that needs to be completed not by you, the borrower, nor the realtors, but by the homeowners association, management company, or the trustee of the homeowners association. So we don't just underwrite you, the borrower, when you're making a purchase of a condo, but we're looking at the health of the homeowners association. So we need to see all the condo documents that go along with that, what their budget is, how much they have in reserves, and to make sure they have adequate insurance as well. So we're looking at the health of that association. Three big things that we're looking for. Is anyone that's in that condo association currently in arrears, meaning they're not paying their homeowners association dues? Are there any special assessments coming up front, coming due? And that's an important question as a buyer. You want to know if all of a sudden the condo association's getting a new roof and therefore just after moving in you're going to be left with a big assessment bill. And the third thing is there any pending litigation? So we need to know if the condo association has someone suing them, and if that's going to interfere with the soundness and the financial soundness of that condo association. So when you buy a condo, we're not just underwriting you as the borrower, but the condo association as well. And Calvin, it can make a difference if you're purchasing a mass housing loan, for example, or an FHA loan. We need to make sure that if it's an FHA, it's FHA condo approved, and if it's for mass housing, that there aren't, it isn't on what we refer to as the exclusionary list, meaning there's already mass housing has lent in that project to the maximum that they will allow, because that could make a difference on your approval and specifically on what program you're applying for.
Great, fantastic, yeah, very, very helpful information. Now, when people have approved for a pre-approval letter, and they have accepted, an offer from the seller, if you will, and also they signed a purchase and sale, and home inspection, appraisal, everything has been done. How long will it take for a loan to close? Is that 30 days, 45 days, 60 days, 90 days, or?
Right, so that is an excellent question because it depends on where you're going to get your loan. So for example, at my institution, we can do that once we have everything, once we have all your documents, which I get from you at the time of pre-approval, but then we get perhaps updated documents at the time that your inspection is completed, like maybe an updated bank statement or updated pay stub. And then we get your tax transcripts from the IRS, which are required now, as well as a copy of the appraisal and the title work from the attorney running down 50-year history on the property. We then submit it to underwriting for what's considered your loan approval and getting that all-important commitment letter, meaning we are committing to lending. And that is a critical date, Calvin, because that's the date that your earnest money deposit is at risk until. So we need to prove that we are going to provide that loan. Typically, our turn time is about 48 hours once we have everything in-house and have submitted it to underwriting. But that's an excellent question for you to ask your lender, because if you're not dealing with someone who's local or a direct lender like we are, for example, it's a broker instead, that turn time could be significantly longer.
Great. And in terms of getting the pre-approval, during the process, a lot of buyers are not aware of as far as like budgeting wise, their closing costs and stuff like that. Should the buyers ask their lender or mortgage broker to provide them with what is called a good faith estimate? So what is a good faith estimate exactly?
Okay, so there's a good faith estimate that's required by law to be given to any buyer within 3 days after an application has been taken. Now, technically, the application is not taken until that address is plugged in. So meaning not until your inspection is done do I plug that address in and we lock your loan. And then by 3 days from then, I'm required by law to disclose that good faith estimate to you. However, at the pre-approval, I'm going to give you something called a detailed transaction overview that will go over every potential penny of cost so that you know the sticker shock, if you will, on your payment, your proposed payment, as well as the proposed cash to close. So there's so much more, Calvin, than just your down payment when you are coming to closing. We have to account for escrows, which is what that means is your taxes and in your insurance, and you have to total do 14 months worth of insurance up front, as well as potentially 4 months worth of taxes, and then all of your closing costs, and then what we refer to as reserves. So we can't essentially wipe you out of every penny that you have. We need to see you have at least 2 months worth of reserves, depending on the program, potentially more.
Great. And with a lot of instances where the loan officer has issued an approval of the loan qualification or the pre-approval letter, and towards the middle of the transaction, I would say 70%, 80% of the transaction process, the buyers and the lender found out that they couldn't qualify the loan, or the buyers cannot get the loan to close the property. And so the bank has to deny the loan. So in this case, what would the buyer get from the lender so that the buyers could get the full deposit back from the seller? And there's a letter called denial letter. So two questions. Why the loan get denied or disapproved during the process? And what is the denial letter?
Right. So at my company, if we've given you a thorough pre-approval, the denial does not happen unless something material has changed. Like, for example, you lost your job, or there's something wrong with the property, and the property is not financeable, which of course we wouldn't know at the time of pre-approval. We'd know once we have the appraisal in. Or there could be a title issue, and the attorney says there's a major red flag here, and we can't lend because of something with the title. So in that case, we would give you something called a denial letter because we cannot lend at that point. The denial letter must be given by the time of your commitment date, which is that all-important date written in your purchase and sales agreement. And what that means is you're telling the seller, we're sorry, but we cannot lend, and so therefore you're entitled to all of your earnest money deposit to be refunded to you at that time. If, however, a commitment letter was issued and then for some reason there was a denial following that, or you failed to provide one of those conditions that were listed as we're committing to lend pending we receive these items, and those items are not received in time to close, then your earnest money deposit is at risk. So you want to make sure you're dealing with a competent lender. A local lender is what I strongly recommend, and that you're dealing with a licensed loan officer, and you've thoroughly reviewed that commitment letter before you've provided it to the realtors to make sure those conditions are feasible and that you can meet them, because it's your earnest money deposit that is at risk.
Great. And so a lot of buyers that I bump into, most of them have 10% down or even 5% down, or any buyers that have less than 20% down. And if they have less than 20% down payment, then they should pay, or they must pay, the PMI. And so that would be an added cost to them on a monthly basis and throughout the term of the loan as well. So what is the PMI, and how long does the buyer or the homeowner have to pay the PMI throughout the term of the loan, and when it's going to be ended?
That's an excellent question, Calvin, because there have been some recent changes in the FHA government-insured loan that now says that once you obtain an FHA loan, you cannot get rid of that PMI. It will not end as long as you have that loan. And that was effective June 1st of 2013. So your only way to get rid of that is to pay off the loan completely or to refinance out of it. There are multiple programs that are available for you if you're putting less than 20% down, such as a USDA loan, which is a rural development program that allows for 100% financing. You actually don't have PMI on that, but there is a monthly guaranteed fee that they do charge, significantly less than what you'd see on other PMI programs. FHA requires PMI, like I said, which is private mortgage insurance for the length of the loan. And then there are other programs such as VA, which is a veteran loan. If you are a veteran and are eligible for a VA loan, and that's determined by the VA and your length of service with them, you may be able to waive that monthly PMI. And then finally, we do have something special here in Massachusetts called mass housing, which they will allow for as little as 3% down with no monthly mortgage insurance if you qualify based on their income restrictions.
And also, there are a lot of programs out there that you just mentioned that the buyers might qualify for. Based on your experience, or most recent experiences, and with the improved housing market, if you will, what type of loan programs that are most popular recently, that the buyers either will qualify for or will go for it?
Sure. So probably the most popular, I would say, here in Massachusetts is the mass housing program, because it does have that very attractive 3% down as long as you meet the income qualifications. And when I say income qualifications, Calvin, you can't make more than a certain amount based on what county that you're purchasing in. And then we do have for Fannie Mae and for Freddie Mac as little as 5% down. And there are options, even when it comes time for that with mortgage insurance. You could do monthly mortgage insurance, or you could do something called lender-paid mortgage insurance. And what that means is essentially it's built into your interest rate. So you'd have a higher interest rate than you would if you paid the monthly mortgage insurance, potentially an eighth or a quarter more. It depends on the loan specifics to your loan, your credit score, and your down payment and so forth. But you could potentially have no monthly mortgage insurance with that as well.
Mm-hmm. Great. And so I think you have touched on a little bit in terms of what is the difference between a pre-approval letter versus a pre-qualification letter. Now, as far as I know, the pre-qualification letter, lenders, especially nowadays with the stringent requirements from the lending industry, and also with what the sellers are looking for, I don't think a lot of lenders that are issuing a pre-qualification letter, if you will. So a lot of times sellers and realtors are looking for a pre-approval letter. Mm-hmm. But for the sake of discussion, if you could explain what is the difference between a pre-approval letter and a pre-qualification letter, and which one weigh the most?
Certainly. So a pre-qualification is kind of, if you will, pie in the sky. It's, hey, if I make X and my debts or liabilities are Y, then what could I get approved for a loan? That's what a pre-qualification is. You might find a pre-qualification with an online lender or with a bank where they just look at your savings account and they just pull your credit and they go based upon what you have told them. They say, yes, you could be pre-qualified for X amount as a purchase price. This is not something you can take to your realtor to make an offer on. What you need is a true pre-approval, and that is when you're dealing with a licensed loan officer that is going to look at all those income documentations and asset lists that we started at the top of the show with, which is 2 years complete tax returns and 2 most recent bank statements, 2 pay stubs, 2 years W-2s at a bare minimum. And then of course we can get more necessary for documentation beyond that. For example, if you receive Social Security, we need a Social Security award letter. If you receive alimony or child support, we need a copy of the divorce decree showing how long that's going to continue for. Must be a minimum of 3 years. And we have to prove that you're receiving it on a timely manner. And the same goes for if you are paying alimony or child support. We need a copy of the divorce decree, and we need to prove that you're making that liability payment on time each month, because it is an obligation that you are responsible for. And we need to see that it's going to continue for at least 3 years, or we can actually not have to debt you for that. So a key question for you, Calvin, as a realtor, is when you're representing your seller and you have an offer from somebody, you want to call the lender that's on there, someone like myself, and say, Kathleen, have you looked at the tax returns? That's the key question, and I think that's the number one question for you as a realtor, and then also for the consumers watching this TV show today, is to say, if nobody looked at my tax returns, that means I'm not necessarily pre-approved. And the key thing is, like, for example, when I sit down with someone and do a buyer's consultation, I make sure that they are working well within their budget. Probably the big question I get right up front is, hey, what could I get approved for? And I say, well, that could be apples and oranges. I need to know 2 things. Number one, I'm happy to show you what the maximum is that you could qualify for, but more importantly, let's go over what that potential monthly payment is for you and make sure that's within your own personal budget, because that can often be a very big difference. You might be, for example, okay and comfortable with a monthly budget based on a loan of $250,000, even though you could qualify for a loan of $300,000. And at the end of the day, you need to be comfortable with that payment, because it's you making it, not me and not you, Calvin.
That's for sure.
Yeah.
There are a lot of different loan programs out there. I think the most popular ones that you just mentioned, like 15 years fix or 30-year fix, or even mass housing, FHA, VA, and also other, loans like jumbo loans, stuff like that. And one special or unique loan program that most contractors or buyers that want to get for renovation of their homes, or fixing up their homes or something like that. And with this program, I believe that there are more documentations are required and also the home has to appraise up to the value of the borrow amount, including the home purchase amount, and also the cost of construction or renovation of the home. This is called 203K. So if you could share a little bit detail about what this loan is all about.
Sure, it'd be my pleasure to. So a 203K is what we refer to as a rehabilitation loan. That is an FHA government-insured loan, so you are required to pay PMI for that for the life of the loan. But what this is a great program that will allow you to buy a home and maybe do the necessary repairs. So maybe, Calvin, you just have the 3.5%, that's the minimum down payment for the FHA loan, but you don't have the necessary money to put on the new roof that's needed, maybe siding, appliances, you could have all types of work that's done, new windows, any type of renovation like that. So the key thing for this is you can only qualify for 203K loan if it is your primary residence, and the other key thing is you are not allowed to do those renovations yourself. So if it's something that you're looking to do the renovations for, this is not the loan program for you. And the 203K, we need to, at the time of application, get a bid from your licensed, insured, and bonded contractor, and they cannot be related to you in any way, shape, or form. If they are, that is a conflict of the loan. They can call the loan in if they find out they are related to you. So it has to be an independent person that's basically one step removed from you. And then we have given that bid and all the work that's going to be done to the property to the appraiser. So the appraiser goes out and appraises the value on what it will be worth once this work is completed. And then we will lend 96.5% of the future appraised value. But keep in mind, we're also going to put 10% in reserves in case those bids are not quite what they end up being at the end of the day. Unfortunately, construction tends to work that way. And we also are putting aside money for permits, and then there'll be re-inspections and so forth. But the two key things for you to remember, Calvin, is that this must be for a primary residence and that you are not allowed to do the work yourself nor any family member.
Okay. So when you said that about 10%, now is that part of the reserves, or is that part of the contingency costs? Because in construction, you need contingency costs for overhead.
Correct, and that is kind of the contingency cost.
Okay.
We're putting that aside in anticipation that those you run into issues during the construction and you need more than what we had allotted for.
Okay, so when you mentioned about related to others, not including best friends, right?
Yeah. Yeah, I would say as long as you're not related to them and neither is your spouse.
Okay. Okay, someone that you don't know, actually.
Correct.
Yeah,
it has
okay.
to be independent. The key there is independent, and it can't be an uncle or
best friends, or not even
Yeah,
that.
you're
Okay.
really supposed to have somebody who's independent.
Right.
That's and they will be checking.
Oh, they will be checking.
They will be
Wow,
checking.
okay.
They
You
will
mean
be
the lender?
checking. The lender will be
Yeah.
checking, and they will be checking. The number one fraud actually that's committed now, Calvin, is
I
someone
see.
saying it's going to be their primary residence, and then they actually never move into the property. So be very cautious. Make sure if you say it's going to be your primary residence, you fully intend to move in within 60 days of closing. That is the law.
I see. So with this loan here, I mean, because I have people that inquire about this type of programs, and they said, one other thing that they said, should I refinance or could I refinance after I close on a home, and my home also has been completely renovated. And so can people refinance, to a 30-year fix or a 15-year fix?
Yes, and I have done that. I've done some 203K loans and then refinanced them later even into a mass housing where they got rid of that monthly mortgage insurance essentially. However, the key is there's no guarantee that down the road the house is going to appraise at enough to refinance, and you need at least 3% equity in order to do so, and that you'd still qualify. So you need to just be cautious of that. If someone's promising down the road to refinance, it may or may not happen because perhaps your job has changed or your income or your assets have changed and maybe the value's not there. So just be cautious of that. There are no guarantees, but yes, you can potentially refinance down the road out of that type of a loan.
Great. And before the closing, there are a lot of times, I would say 99.9% where the buyers and the sellers and their attorneys, of course, receive the HUD, which is called settlement statement. So one of the items on there that the buyers usually question, because of course they require a homeowner's title to protect their title, and there is also the lender's title And they said, should I pay for it? I mean, who should pay for it? Well, I said the lender. I'm sorry, the buyer, of course. So what is the lender's title and protects whom?
Okay, so the lender's title protects the lender, and it is $2.50 per thousand of the loan amount. So based on your loan amount, that is the cost of the lender's title insurance. And that's probably a big question I get, Calvin, when someone comes to refinance. Someone will say, well, no, I don't need to buy that because I already bought it at the time of purchase. What you purchased and what you're thinking of is something called owner's title insurance, which is a one-time purchase that you would buy at the time that you buy the property. And you literally can get the cost of the lender's title deducted from your owner's title if you buy it the day that you close. You can always buy owner's title insurance if you didn't do so at the time of your closing, but you'll never get it for that discounted rate that you would if you bought it the day of closing. Owner's title protects you as the owner. Lender's title protects us, the lender. Lender's title is required anytime you get a loan. Owner's title you typically only get at the time that you make a purchase.
Mm-hmm. And the last question is that what is a jumbo loan?
A jumbo loan is basically any loan over the conforming loan limit. A single-family loan limit currently for 2014 is $417,000. So as soon as we lend $1 more over $417,000, it's considered a jumbo loan, which is different loan parameters, requirements, and guidelines. We need much more documentation, and for a jumbo, you need a minimum of 20% down.
Great, and I want to thank you for sharing.
My pleasure.
I believe your expertise and your insight information have been very helpful.
Thank you. It's been a pleasure to be here, and hopefully you found this useful.
I'm sure they will. So having said that, it is important to take the first step of getting yourself pre-approved before even looking at any properties, especially nowadays with the improved real estate market. Sellers are tend to more sensitive with whether the buyer is pre-approved or not. So without a pre-approval letter, the seller will not even consider your offer, especially in the multiple bidding situation. Now, there are a couple of benefits of having a pre-approval letter. Number one, you know what type of loans that you might be qualified for. And number two, what type of interest rate that you might get. Number three, your estimated monthly payment. Number four, the down payment that you intend to put towards the purchase of the property. And finally, the closing costs that you should budget for before the closing, because when buying a home, your budget could be very tight. Unless you have tons of money, then it shouldn't be any problem. But if not, then budgeting is one of the most important items that you should consider when buying a home or an investment property. Well, I hope the information that Catherine and I share today are helpful to you, especially when you are a first-time home buyer. And I want to thank you for watching. See you next time.